Hi, this is Chris German. Welcome back to the Apartment Dealer Show. Today we're going to discuss interest rates. Of course, interest rates have been on the rise, but what does that really mean to multifamily properties? What should you be cognizant of as a multifamily investor? So this is what we're going to take a look at. Now, if you watched our video interview with Bruce Norris not too long ago, he and I discussed interest rates and the impact it is having on single family residential real estate. Of course, here locally, we've seen values begin to decline, homes staying on the market longer. Why is that? It comes down to math. Homes, when you look at the affordability factor, essentially a person's income relative to the potential mortgage, now that interest rates have basically doubled for single family homes, that affordability factor has taken a significant hit. So if it is just, again, a math question, we will see a significant decline in home values unless there's some intervention from some outside sources. Well, what about multifamily? Now, multifamily, the interest rates have not gone up as much as they have in a single family residential. Multifamily interest rates have not doubled. We basically have gone up about a point and a half, maybe 1.6% over the course of the last year and a half. So does that mean anything? It seems like such a small amount, one and a half points. Could that really have an impact? As of today, I would say that it's had a small impact, not a significant impact, but a small impact. If nothing else, investors are definitely anxious about, well, if the rates continue to increase, what does that mean to potential purchases down the road? What does that mean to investors who your loan, you have a fixed loan, but it's going to move into its adjustable period here over the next 2, 3, 4, 5, 6, 12 months? Well, what will that mean if we're looking at a much higher interest rate? So I wanted to dive into some specific numbers. Let's take a look at the math. Let's take the emotion out of it. Let's forget what the talking heads are saying on TV in terms of their predictions. Let's look at some simple math and let's see if we can come to our own conclusions of what impact interest rates will have on multifamily. So now let's take a look at a hypothetical transaction. We're gonna use a multifamily property that's valued at $1 million. So in this hypothetical purchase, let's say a buyer's putting 40% down. That's been about the average down payment for the last few years now that that's been required for purchases. Now let's say that property's gross income was $72,000. The expenses were $30,000. So the net income is $42,000. That would give us a cap rate of 4.2. That was about the average cap rate as of a year ago. And the interest rate we're using to start as our baseline, 4.5%. So by the time you factor in the mortgage payments, this buyer's potential net cash flow would have been $5,519. Okay, now moving forward, we just raise that interest rate by 0.5%. So we go from 4.5% to 5%. Same $1 million building, same 40% down payment, same income, same expenses. The only thing that has changed is this increase of 0.5 point. Well, what happens to the cash flow? We drop from 5,519 to 3,349. That is a decrease of cash flow by 39%, just by increasing the interest rate 0.5 point. Well, let's do that one more time. You have the same building, $1 million purchase, 40% down, all the same income and expenses. The interest rate now, instead of being 4.5, where we originally started, is now at 5.5, about where we are today as the recording of this video. Well, the cash flow has now dropped from 5,519 to 1,119 annual dollars. And that's an 80% drop in positive cash flow from where we started. And we've only gone up 1 point. Well, let's take it now to 6%. Same building, same metrics. The cash flow now, if you're only trying to put that 40% down payment, the $400,000, we're negative annually, $1,168. We're 121% below decrease in net cash flow. So let's say then a buyer obviously is not going to sit okay with the fact that their cash flow is dwindling because of the interest rates. So a buyer, an investor says, look, the $5,519, that's what I want as my positive cash flow, okay? It's a modest return. If I'm going to go through the risks of being a landlord and dealing with tenant eviction moratoriums and rent stabilization ordinances and phone calls in the middle of the night and all the rest, I need to make cash flow. And that would be a good argument. I would never do a deal where I'm not making positive cash flow. There's just too much involved to not require a return. Okay, so what we're looking at now is, again, we're going to move the interest rate, but what we're fixated on here is the buyer, the investor says, I want to earn $5,519 as my rate of return. So we have that same baseline property, $1 million purchase, 40% down, 4.2% cap rate, and back to our original 4.5% rate. Now, of course, that rate is gone, but I just want to give you a baseline starting with last year versus where we are now. Well, now let's take that interest rate up 0.5%. If the buyer still wants to earn $5,519, then the price of the property has to drop from $1 million to $957,150. That's a $42,850 change in price. If we take the rate to 5.5%, which is about the average rate today, in order for the investor to still earn 5,519 positive net cash flow dollars, the price of the building must drop from our original $1 million to now $916,800. That's a drop of $83,200. And if you take it forward another 0.5% to 6%, now the building would have to sell for $878,808 to still earn the 5,519 net income, which is a difference in price of 121,200. So what you have to decide for yourself is, while interest rates are rising, and the assumption is they will continue to rise, how much we don't know, but we're not going back to 3.5% anytime soon. What will the market, the investor base, make of this? Are they going to be okay with dwindling returns? Or are they going to demand higher cap rates? And until they see higher cap rates, they're just going to sit on the sideline. Now, as a seller could say, well, if that's the case, if the buyers want me to lower the price of my building, you know what? I'm not a seller. I'll stand on the other sideline for the time being. And that definitely could be a potential scenario where we see little deal flow. Here's the problem with that, and I've been doing this for a while now. Regardless, good market, bad market, there's always sellers. There's always the instances of families that inherit a building and there's multiple siblings and they choose to sell so everyone can go their own way. There's divorce, there's different things that cause a sale, regardless of what the market fundamentals are at a given time. Well, if you get 1, 2, 3 sales comps in a given region at an adjusted price, well, guess what? That is the new price. And you could still have a situation where sellers say, well, then I'm not going to sell. But as we saw in 2008, 9, 10, and 11, when the market was at its bottom, there was still a lot of deal flow. Obviously, somebody chose to sell their buildings, and even though they knew that they were not selling for those peak prices that we saw in 2006 and 2007, they understood that, well, this is the reality of the market. Keep in mind, if you're selling to do a 1031 exchange, okay, then it's all relative. And this is what we educate our investors about here, is that it is a fallacy to say, I'm going to sell high and buy low. That's just a fallacy. It is extremely difficult to try to time something like that. What's more realistic is that if you're in a market that's inflated, okay, then yeah, you're getting a high price for your property, but you're also paying a high price on the other side, which is okay because you have that much more equity that you're going to roll over into the new property. Same can be said if the market adjusts. Well, yes, you have to sell your building for a lower price, but you're also buying inventory that's priced lower. It's all relative. But who is price adjustment not relative to? Well, it's those individuals that are going to sell and cash out. They're going to sell, take all their proceeds, and ride off into the sunset, right? We see investors do that for many, many reasons. Well, then for them, it's not all relative because whatever price they sell for today, that literally is all the dollars that they're going to have for in the future, for their future retirement. And so an argument can be made, depending on your review of the analytics I just went through, what you make of it, is if you believe that properties are going to adjust here in the near future, then for those investors who know in their heart of hearts that they're going to be selling, say, in the next 2 to 3 years, assumably you're going to see a higher price for that sale today than you would 2 or 3 years from now if interest rates continue on the same trajectory as we see them now, and that's at an increasing rate. And keep in mind, rates are not that high. I realize that 5.5% is not as attractive as 3.5%, but 3.5% was an unrealistic rate. Okay. What's more of an average rate would be 6.5. When the market was inflated in 2007, we were underwriting properties at that time using an interest rate of about 6.25, 6.5. That was more of a normal interest rate. So today, we're at about 5.5, 5.6% on a multifamily commercial property loan, 5-year fixed loan. That is closer to a norm. And if we were to tick up to 6%, to 6.25, 6.5, what I'm saying here is that that would not be out of line. Okay, that's not like us jumping from where you are here now to say stories I've heard about when interest rates were 10, 12%. That was before my time. God forbid interest rates go that high based upon the math that I showed you. That would be catastrophic to property values. So I wanted to share this information with you so that as you discern, as we're closing out 2022 and heading into 2023, and hopefully as you're coming up with your strategy for your multifamily properties, remember, we have 3 pillars of the financial legacy. We have pillar 1, which is maximization, increase the value of our properties from within so that we can increase the equity, to move to pillar 2, which is growth. How are you going to grow? I wouldn't suggest standing by the sideline. So what is your strategy for growth? Given rising interest rates, given the various oversight, political intrusions into multifamily ownership, what's your strategy? There's always a winning strategy, okay? There's never a bad time to buy real estate. There's just bad ways to buy real estate. The wrong deal, the wrong financing, it's not structured correctly, so on and so forth. What's your strategy? I hope today's information is helpful to you. We have more educational videos, of course, that we're going to be releasing. So if you have not already, be sure to subscribe to our channel. Set yourself up for alerts so that when we do release videos, you are notified when those videos come available. And share these videos with other landlords. It's very important, given that the market is in flux as of right now, that every landlord has that information that's current, that information that's going to assist them in their investment strategy, that information that's going to really make the difference between those that succeed at a very high level or those that don't do as well as we continue through the current market. Chris German from The Apartment Dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.